Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, September 11. The softer than expected PPI read from the US yesterday further fueled the dovish Fed expectations ahead of today's CPI data, while a 35% rally in Oracle backed the AI rally. Here in Europe, the European Central Bank is expected to maintain its interest rates unchanged when it meets today, while the war in Ukraine is taking an uglier turn after Poland had to shoot down Russian drones yesterday that violated its airspace. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So sentiment across financial markets is rather bullish, I would say, after the US PPI update yesterday suggested a large drop in input price inflation in August in the US. Both headline and core PPI figures unexpectedly fell last month, and the annual figures were pulled down to 2.6% for the headline number and to 2.8% for the core figure. Those still sticky near the 3% level, while yesterday's PPI figures did not interfere with the dovish Fed expectations, nor did they, boost them actually. So the US 2-year yield was slightly, but just slightly lower after the PPI data, and the S&P 500 hit a fresh all-time high level, but spent the rest of the session giving back the early gains. Oracle, on the other hand, stood out with a 35% rally after its quarterly results shine thanks to a massive $300 billion deal with OpenAI. Nvidia added 3.85% after TSMC recorded its second best month of sales in August, while CoreWeave jumped nearly 17% yesterday. Voila, AI-related companies continue to reveal strong results and the rally is clearly on. But note that not all of them are thriving and not all risks are gone. Because the chip design software maker Synopsys' 35% fall yesterday actually reminds all of us that the trade war remains a major risk to the chip business, and Donald Trump's tariff threats are just a social media post away. So keep in mind, but happily, while the prospects of lower interest rates in the US from the Fed is obviously an extra backing of appetite for technology stocks these days, as these growth companies' valuations rely mostly and heavily on the discounting of their future revenues and also their future revenue expectations. And as such, the lower the interest rates, the lower the discount factor and higher the valuation. So it's just a mathematical reality. As such, the S&P 500 and Nasdaq are waiting for today's CPI update from the US near a record high level, ready to print fresh records after the data. And many bank analysts revise their S&P 500 targets higher these days, suggesting a rise to around 7,000 level between this year and the next. And there is no particular sign of stress among investors in the market either, because the VIX index, which is a major gauge of market fear, is rather low these days. So all eyes are on the US CPI update due to be released today. There, the headline inflation may have ticked up to 2.9% from 2.7% printed a month earlier, and the core inflation in the US is seen still sticky near the 3.1% level on a yearly basis. A set of softer than expected figures could boost the bets that the Fed may opt for a jumbo rate cut when it meets next week to give support to the US jobs market that appears to be crumbling these days under the pressure of Trump policies, while a set of stronger than expected inflation data from the US today will eventually convince the Fed that starting the rate cuts with a 25 basis point cut and cut 2 more times if necessary would be a better thing to do. So if that's the case, we could eventually see some consolidation in the US 2-year yield and the US dollar, and limited extra appetite for the S&P 500 and other equities. Option markets actually suggest that the CPI report today could could send the S&P 500 by 0.7% up or down depending on the data, and that's actually less than the average move of around 0.9% on a typical CPI day in the US, and it's also smaller than the move expected at next jobs day in the US. So that means that the market investors are giving less importance to inflation data today and more importance to jobs data, and believe that the Fed's next monetary policy decisions will be mostly and highly driven by the weakening jobs data rather than inflation data that hardly matches the fears of seeing inflation spike due to tariffs. Maybe, but just maybe, the economic weakening will indeed counterweigh the tariff-led price pressures in the United States and let the Fed do what investors want it to do: cut these rates. In the FX space, the US dollar is flat this morning, still below its 50-day moving average, while the euro dollar consolidates below the 117 mark after yesterday's decline, partly due to the French political turmoil and the widening 10-year yield spread between the French and German papers. The European Central Bank meets today, ladies and gentlemen, and is widely expected to maintain the interest rates in Europe unchanged near the 2% level and reiterate its data-dependent approach for the next meetings. But with better tariff visibility with the US, a stronger than expected growth numbers that we saw last week, and some slight but surprise upside pressure in the latest inflation numbers, while the bets for another European Central Bank rate cut is now around 50-50. So this divergence between slightly more hawkish European Central Bank expectations and softening Fed expectations remains supportive of a further rise in the euro-dollar. But again, this widening spread between the French and German 10-year yield could eventually limit the upside potential in the euro-dollar ahead of now closely watched Fitch update on French sovereign rating. So keep an eye on that space and note that there is resistance near the 118 level in the euro dollar to be broken if the move is to continue toward the upside. Now, speaking of France, if you didn't know, France was blocked yesterday and people were out protesting against Macron and the divided French government and the budget and politicians' inability to find a budget solution. They blocked everything. And on the top, well, French politicians are taking turns these days proposing their own budget solutions, and they're pretty much all designed to fail, really. But if you look at the CAC 40 yesterday, well, you could barely tell that thousands of people were out to block everything in French streets. So my conclusion is that investors aren't losing their cool over the political turmoil in France, and neither should you. And the same applies to the Japanese Nikkei, mind you. The index just hit a fresh all-time high level today, and that despite the political uncertainties in Japan following the recent resignation of their PM ahead of October election. But while politics at home may not shake sentiment among especially international investors, while geopolitics certainly do, because the war in Ukraine is actually taking an uglier turn since Russia fired drones on Poland this week, which Poland thinks hasn't happened by mistake and was a test from Russia to see how NATO nations would respond if Russia expanded its attack on the continent. Poland, of course, downed the Russian drones yesterday and as such became the first NATO nation to shoot in the Ukrainian war, and that's kind of big in terms of geopolitical importance. So European countries are now considering bigger sanctions against Russia, obviously. As such, the US crude rallied 1.5% yesterday, but the nearly 4 million barrel build in US inventories last week actually did encourage some oil bears to sell the tops yesterday, and oil is under pressure this morning. So prospects of slowing economies and higher OPEC supply are the major arguments at the bears camp, while the soft US dollar and the geopolitical tensions keep the bulls alert these days. As such, the support in US crude is seen near the $62 per barrel level, while resistance should come in play near the $65 per barrel level, which is a key Fibonacci level that is sandwiched between the 50 and 100-day moving averages. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.